Hello and welcome to this video on understanding what the forex market is and how to do forex trading. Forex trading is becoming increasingly popular as people look to invest in the global currency market. In this video, we will provide you with a comprehensive overview of the forex market, explain how it works and provide you with some basic steps to get started with forex trading. Part 1: Understanding the forex market. The forex market, also known as the foreign exchange market, is a decentralized global market where currencies are traded. The forex market is the largest financial market in the world, with a daily trading volume of over $5 trillion. Unlike other financial markets, the forex market operates 24 hours a day, 5 days a week. This means that traders can buy and sell currencies at any time, from anywhere in the world. The forex market is comprised of different types of participants, including banks, corporations, governments, and individual traders. Each participant has a different motive for trading currencies, which creates a dynamic and ever-changing market. Part 2: How forex trading works. Forex trading involves buying and selling currencies in pairs. For example, if you believe that the euro will appreciate against the US dollar, you would buy the EUR-USD currency pair. If you believe that the euro will depreciate against the US dollar, you would sell the EUR-USD currency pair. Forex trading involves speculating on the future value of currencies. Traders use various technical and fundamental analysis tools to determine whether a currency is likely to appreciate or depreciate in value. The forex market is also known for its high leverage, which allows traders to control large positions with relatively small amounts of capital. This means that traders can potentially make large profits with a relatively small investment. However, high leverage also means that losses can be magnified, so traders need to be careful when using leverage. Part 3: Getting started with forex trading. To get started with forex trading, you will need to choose a forex broker. A forex broker is a company that provides traders with access to the forex market. When choosing a forex broker, it is important to consider factors such as regulation, trading platform, customer support, and trading costs. Once you have chosen a forex broker, you will need to open a trading account and deposit funds into the account. You can then begin trading by selecting the currency pairs you want to trade, and placing orders to buy or sell those pairs. It is important to have a solid understanding of the forex market and to have a well-defined trading strategy before you begin trading. This will help you to make informed trading decisions and minimize your risk of losses. Conclusion. In conclusion, the forex market is a complex and dynamic market that offers traders the potential for significant profits. However, forex trading also involves significant risk, so it is important to have a solid understanding of the market and to have a well-defined trading strategy before you begin trading. We hope this video has provided you with a helpful introduction to the forex market and how to get started with forex trading. Here are some tips for beginner forex traders. 1. Educate yourself. Before you start trading, it's important to educate yourself about the basics of forex trading. This includes understanding the market, how to read charts, and the different types of analysis you can use to make trading decisions. 2. Practice with a demo account. Most forex brokers offer demo accounts that allow you to practice trading with virtual money. Use this opportunity to familiarize yourself with the trading platform and try out different trading strategies without risking real money. 3. Start small. When you're ready to start trading with real money, start with a small amount. This will help you minimize your losses and gain confidence as you learn. 4. Use stop-loss orders. A stop-loss order is an order you place with your broker to automatically close a trade if the price falls below a certain level. This can help limit your losses and protect your account. 5. Keep an eye on the news. Economic news and events can have a big impact on currency prices. Keep up to date with the latest news and announcements to help inform your trading decisions. 6. Don't let emotions drive your trades. It's important to stay calm and avoid making emotional decisions when trading. Stick to your trading plan and be disciplined in your approach. 7. Use risk management techniques. Risk management is an important aspect of forex trading. This includes setting a risk-reward ratio, using stop-loss orders, and diversifying your trades. Remember, forex trading can be risky, so it's important to approach it with caution and only trade with money you can afford to lose. Good luck!